There is one account where the money goes in tax-free, grows tax-free, and comes out tax-free. The IRS built this into the tax code on purpose, and the average earner making $150,000 a year is leaving over $2,700 on the table every single year, simply because nobody explained it to them. We are halfway through 2026. Every paycheck that has hit a bank account so far this year has had federal taxes, state taxes, and FICA taken out before a single dollar ever arrived. For a $150,000 a year earner, that is roughly $30,000 already paid to the government just through June. There is still time to claw some of that back. Not all of it, but enough to matter. And the single highest impact move available right now does not require a tax attorney, a CPA, or anything complicated. It requires one account most people are either not using or not maximizing. The account is the Health Savings Account, or HSA. Most people know what it is. Far fewer know what it actually does. Here is what makes it different from every other tax-advantaged account in the United States. It beats the system 3 separate times. Most accounts beat it once. A traditional 401k defers taxes on the way in, but they come due on the way out. A Roth IRA flips that, after-tax money goes in, and growth and withdrawals are tax-free. But an HSA does all three. The contribution is tax-deductible, the money grows tax-free inside the account, and when it comes out for qualified medical expenses, it is not taxed at all. No other vehicle in the tax code does that. Not one. But here is the part that almost nobody is talking about, and the reason this video exists right now. The One Big Beautiful Bill Act, which became law this year, just expanded who qualifies for an HSA. Bronze-level plans and catastrophic plans purchased on the health insurance exchange, which previously did not qualify, now count as high-deductible health plans starting January 1, 2026. Millions of earners who have been locked out of the HSA for years just got access, and most of them do not know it yet. There are 5 moves that will have a real impact on a 2026 tax bill. This video covers all of them, ranked by dollar impact for a $100,000 to $500,000 earner. The first one is the most powerful and the most underused, and all 5 have a hard deadline, December 31st, 2026. Start with the numbers, because the numbers are what change minds. The 2026 HSA contribution limit for a family plan is $8,750. For self-only coverage, it is $4,400. Anyone 55 or older can add another $1,000 on top. For a $150,000 a year earner in the 24% federal income tax bracket, maxing a family HSA saves roughly $2,100 in federal income taxes in year 1 alone. That is before FICA. This is the piece most people miss. When HSA contributions go through payroll, meaning they come out of a paycheck before hitting a bank account, they also bypass FICA, Social Security and Medicare taxes. That is another 7.65% on every dollar. On $8,750, that is another $669. Add in average state taxes for someone in a medium tax state, and the total year 1 savings from one move lands between $2,769 and $3,200. That is real money. A car payment for 2 years, a flight to Europe, and a month of groceries, all before a single dollar in this account has grown. Now run the long game. If a 35-year-old maxes a family HSA every year and invests it in a low-cost index fund inside the account, earning 7% annually, by age 55, that account holds roughly $401,000. Every dollar of that money is tax-free, not tax-deferred. Tax-free because it was never taxed going in, and it will not be taxed coming out for qualified medical expenses. The 401k version of that same contribution grows to the same number, but a 24% tax comes due on every dollar at withdrawal, which cuts the after-tax value by over $96,000. That gap comes entirely from a single account decision made at open enrollment. There is one catch, and it is the reason most people leave this on the table. To contribute to an HSA, the earner must be enrolled in a high-deductible health plan. For 2026, that means a deductible of at least $1,700 for self-only coverage or $3,400 for a family plan. Out-of-pocket max caps at $8,500 for self-only and $17,000 for a family. A lot of earners see that deductible and decide the HDHP is not worth the risk. That is a calculation worth running, and for some people it is the right call. But for a healthy 35-year-old with low annual medical costs, the math often flips. The premium savings on an HDHP versus a PPO combined with the HSA Tax Advantage frequently outpace the deductible risk by thousands of dollars a year. And now, as of 2026, there is a group of earners who did not have this option before. Anyone on a bronze level or catastrophic exchange plan. Those plans now qualify. The door just opened. Now for the part that nobody is volunteering. The HSA deadline has 2 layers, and most earners only know one of them. The IRS allows prior year HSA contributions until the tax filing deadline, which is April 15, 2027, for the 2026 tax year. So technically, an earner has until spring to max the 2026 HSA. Most online guides stop there. But there is a catch buried in the FICA savings. The FICA bypass, that 7.65% that does not get taken out, only applies to contributions routed through payroll through a Section 125 cafeteria plan. It does not apply to direct contributions made to an HSA outside of payroll. The gap between contributing through payroll this year versus mailing a direct deposit in March 2027 is $669 in FICA taxes, money that disappears once the year closes and cannot be recovered. The FICA savings window is December 31st. For every paycheck left this year, an earner should verify their HSA contribution is coming out pre-tax through payroll, not sitting as a future direct deposit they plan to make later. This one detail costs thousands of earners hundreds of dollars every year because nobody explains it clearly. Move 2 is table stakes, but the limit just went up and most earners have not adjusted. The 2026 401k employee contribution limit is $24,500, up $1,000 from 2025. Anyone on auto contributions who has not updated their percentage is leaving that extra $1,000 in taxable income, which at a 24% bracket is another $240 handed to the IRS for no reason. Move 3 is the backdoor Roth IRA. And this one requires understanding one rule clearly because getting it wrong costs money. A direct Roth IRA contribution is off limits once modified adjusted gross income passes $168,000 for single filers or $252,000 for married couples filing jointly in 2026. But the backdoor Roth sidesteps that limit entirely. The mechanics are straightforward. Contribute $7,500 to a traditional IRA. There is no income limit on contributions, only on deductibility, then convert it to a Roth. The conversion is taxable in the year it happens, but ongoing growth and withdrawals are not. There is one trap, the pro rata rule. If an earner has other pre-tax traditional IRA money sitting in accounts, the IRS treats the conversion as a blend of pre-tax and after-tax dollars, which creates a taxable event larger than expected. The clean way to run a backdoor Roth is through a workplace 401k that accepts rollovers, moving any existing pre-tax IRA money into the 401k first. Not every plan allows this, so it requires a call to HR before assuming it works. Move 4 is the one that most people over 50 have not been told about. Under Secure 2.0, a new rule took effect January 1, 2026. Any earner who is 50 or older and crossed $150,000 in wages in 2025 must now make their catch-up contributions as Roth. Pre-tax catch-up is no longer an option for this group. The tax is due now, not deferred to retirement. Whether that helps or hurts depends entirely on the earner. For some, who expect to be in a lower tax bracket at retirement, paying now is a disadvantage. For earners who expect tax rates to rise or who expect to be in the same bracket or higher, it is actually an advantage. But the key point is that most employers have not sent a clear notification about this change, and most earners in this group do not know the rule flipped on January 1st. Move 5 is only relevant to a slice of the audience, but for that slice, it is the most powerful move on the list, and its deadline is the hardest one to miss. A non-qualified deferred compensation plan, an NQDC plan, is an agreement between an executive and their employer to delay receiving part of their compensation until a future year when their tax rate may be lower. Unlike a 401k, there is no annual cap on what can be deferred. An executive earning $500,000 could defer $200,000 of it and shave that full amount off their taxable income this year. But there is a catch, and it comes down to timing. The deferral election for 2027 income must be made before December 31st, 2026 under IRS Code Section 409A. Miss the deadline, and the option is gone for an entire year. Once the calendar turns, the decision is locked. There is no going back. Not every employer offers an NQDC plan, but for those that do, this is the one move on this list where the ceiling is truly unlimited and where missing a calendar date has the largest dollar consequence. Run through the 5 moves together, and the picture gets clear. The 401k gets talked about everywhere, so does the Roth IRA, but the HSA delivers the highest dollar-for-dollar return for a working earner in that $100,000 to $500,000 range. It gets the least coverage of any of the 5. Partly because it requires an HDHP enrollment decision, and partly because the FICA bypass is buried in IRS guidance that most earners never reach. What these 5 moves share is that they all require decisions before December 31st to capture the full 2026 benefit. Some can be adjusted in the spring, but the FICA payroll window, the NQDC deferral election, and the health plan enrollment all close when the calendar year closes, and none of them can be backdated. The tax code does not advertise its own advantages. It is not designed to. The earner who reads a 100-page IRS publication does not get a better outcome than the one who acts on a single well-understood principle, as long as they act before the year closes. Back to the $150,000 a year earner at the start. Halfway through 2026, roughly $30,000 already gone in taxes, paid out before a single optimization move was made. What happens to the second half of the year is still a decision that can be made. Max the HSA via payroll. Bump the 401k to $24,500. Run the backdoor Roth if income exceeds the direct limit. Check the secure 2.0 rule if over 50 and earning $150,000. Ask HR whether the company offers a non-qualified deferred comp plan before December 31st. 5 decisions. The government already has the first half of the year. It does not have to have all of the second half too. If you made it this far, thank you. Please like and subscribe, and check out our other videos, dropped weekly. The $2,769 saved this year is not the point. Invest it inside the HSA at 7% for 20 years, and it becomes $10,700, untaxed, sitting in an account the government cannot touch. Do that every year for 20 years, and the total is $401,000 in tax-free assets, built entirely out of money the IRS would have collected if the account had never been opened.